Hey, good morning, everybody, and welcome to another daily market report brought to you by Mike Bjork. Today is Friday. Happy Friday to you all. It's February 4th, so we're finishing up our first week of February here. Yeah, I want to ask a favor from you folks. Just want to get some more clarity. I want to make this enjoyable for you guys to watch. So, any thoughts or ideas as to what you'd like from me to share with you on these reports? Do you want me to maybe jazz up a little music to start off? Do you want me to perhaps some other day? Do you want me to, I guess, dummy it down a little bit, so to speak? Using that word loosely, kind of as do you want me to just kind of break it down actually in layman's terms and explain to you a little bit more what these data means and why it's relevant? Um, Let me know. I want to hear you guys' thoughts. I want to make this entertaining, or at least entertaining, but yet educational, and give you guys ideas as to where the market is for the day at least, and what to look out for. Uh, so, any thoughts and suggestions? Greatly appreciate. Please leave a comment. So let's start off with the economic news we've been waiting for today. We got the jobs reports this week, so let's take a look. Start with the non-farm payrolls. Huge disappointment there at 36,000. They're estimated right around 140,000. This is a huge issue because just to keep up with the population growth, we need 180,000 jobs per month, and we're way below that. This is going to be problems for people coming out of college looking for work. So we're having a lot of issues in this arena here. But then you look at the unemployment rate; it goes from 9.4 down to 9.0. They estimated 9.5. Now, a lot of the people out there, economists, are kind of projecting, okay, this is probably due to the weather across the nation. We've had some bad weather last month, so but to be honest with you, my personal feeling is people are just giving up. People are just sitting off to the side. This is January's readings, and they're just kind of giving up with the job search. Maybe there's not. Maybe losing faith. We kind of saw a little bit of this back when the dot com busted. We saw a little bit of that, but this is pretty big. I mean, from 9.4 to 9.0, and we even had 9.8. So really, we're at 9.8 down to 9.0. That's almost 1%. That's a big, large group of people that seem to be kind of dropping off the wayside. So it'll be interesting if what people are doing. Hourly earnings went up a little bit, so that's kind of nice. So people are getting paid a little bit more. As we saw the productivity, they should, because as we saw, people were the productivity is up, so that means their job companies were getting by with more with less people. So hopefully, yeah, those people are compensated accordingly. Um, so as a technicals, the stock market's down. It's kind of with this mixed data, but it's not down that much. It's just again kind of idle like it's been the last couple of days. So it's been kind of going back and forth. So that could easily switch around, but there's not a whole lot of growth. I think they're just kind of sitting through, deciphering, going through this mixed, conflicting information from payrolls up 36,000, only up 36,000, to unemployment dropping. So we could probably see a little bit more of a change next week, at least with the Dow side. So let's take a look here at the bond market. And as we saw, we already broke earlier this week the 98.50s, as we saw the mark there. As I mentioned, that dark mark there is 98.50 mark, and right now we're on a trending downwards again. So this is normally decent news for bonds, but this is again, I told you, if we didn't continue going upwards and get above that 100 mark here soon, we're going to end up one way or the other, and it looks like right now we're going downwards. So let's take a look here at the long term here. Remember back in December, we're already at those levels right now. We're dropping down to as low as right around 97 itself. So we could easily hit that. So that's a good possibility. So let's keep our fingers crossed, but expect rates to be worse, and it could get worse again. We could test these levels again, and then get another bounce back upwards again. So we'll see. But this is kind of telling me that investors are just kind of cashing in now, making cashing in their profits, and kind of sitting idle until they determine what they want to do. until we have a big correction on the stock market, I would kind of expect rates not to be as good. We need the correction in the stock market for that money to flow back into bonds and drive bonds upwards. So until that happens, and that will probably be when we least expect it. Nobody has the crystal ball to exactly project it. This has gone on for a while. Many of us thought maybe December was going to happen or January. We're already into February. So, all right, folks, have a great weekend, and we'll be in touch.